Hello, dear students. In this video, I'm gonna tell you how to do the followings in Excel. We will make a portfolio of two stocks and calculate its expected beta and risk of the portfolio. So let's start. So we will use some recent data from the internet. We will download it and we will see how to do all these things in Excel. So let's get started. So the number one requirement is to download any two stock prices monthly data for the last 10 years from investing.com into the Excel. Okay, so let's do this step. So I'm gonna open this website. Investing.com is here, and let's download the data of some stock like Turkish Airlines. So I just click here this Turk. So I need to write in Turkish. So Turk airline stock is here. So okay, so this stock, so 19.450 Turkish lira. So you will go here, historical data, and from here, from the time frame, so you will select monthly data. So from here you will select the period, right? So the start, we need to mention the start date. So we have said that we will download the data for the last 10 years. Okay, so let's do it. So now this is 30th of March 2018. So we will just March 30. We have this data from April 2008 till March 2018. So just press this button. So as you press this button, so it will start downloading. So open this file, and yes, so now you're gonna select the first two columns here, so date and price column. So there is some other information given about this stock. So opening price, high, low, volume, traded on this date. So this is the percentage change with respect to the previous month actually. So this is the closing price of the stock, opening price of this month, closing price of this month, the April 2008. This is the opening price of this month, highest, lowest, volume traded 344 million TL Turkish liras stock have been traded in April 2008. It means that. So okay, so let me make it a bit. Okay, so let's download this. Let's copy this stock. So how you're gonna copy it? First you need to select this one. So how you're gonna select? So you can, there are two ways to select this. So first is you do it using your mouse, so it will take time. Let me tell you a shortcut. The shortcut is, so you select these two and you press Control Shift and down arrow. Control Shift down arrow. So you will be able to select all of them. So you just press Control C, copy, Control C, or you can do from here, copy, and then you will open a new Excel file. So in any drive, wherever you want. So here, click here, and this Microsoft Excel file. So I'm gonna open it. So I am gonna rename it with my name, Adnan. I open this file. What I do? Okay, let me open it. So yes, we have here. So I'm gonna just paste it here. So you can just press this button, paste, it will come here, right? Great. So now, so let's insert a new row here just to enter the name of the stock. So the name of the stock is, so let me write it here. have this Turkish Airlines stock price data. So now let's download another stock price data. So I'm going to again to this website. So I write here. So you can write any stock name that you want to download the data. So Turkcell, for example, another stock. The Turkcell, so this stock is listed in 3 different markets: in New York Stock Exchange, NYSE, in Istanbul, Borsa Istanbul, and in Berlin, in Germany. So we're going to use this one, the central one. So the Turkish data. So this is the price of this stock, 15.19 Turkish liras. And we will go to the historical data here. Again, we will do the same. So we will select our time frame, monthly, and from here, so last 10 years data. So I will press here, so 03 March 30, 2008. So let's apply. Let me make it like this. So from April 8 to March 2018. So we're going to download this. Press this download button. Again, just open this. So it will be like this. So this is Turkcell, T-cell historical data. You see here the name. So again, we will select the first 2 columns. The same data is given here. The price, the closing price in the month of April, the opening price in the month of April 2008, highest price of the month, lowest price of the month, the volume traded in this month, and the change as compared to the last month. The change is 8.06% as compared to the last month, the March 2008. Okay, so we're gonna select, we're gonna copy the first 2 columns. How are you gonna do it again? So you will select first 2 column and you will press Control, so Control Shift down. It will select the whole 2 columns. So I just press copy, Control C, or just press this button, Control Copy. Let's come to our sheet, Excel sheet on which we were working. So just paste it here, select this column D here. So just paste it. Okay, we have the data. So let's name it so that we know. So T-cell, let's write it. Again, I am gonna select these 2 and merge and center. So let's make it bold. Okay, now we have 2 stock price data. Okay, monthly data, 10 years monthly data. Okay, so one thing more that we need is the market portfolio data. So the market portfolio will be, in this case, as these stocks, they are from Istanbul, Borsa Istanbul, Istanbul Stock Exchange. So we're going to use a market portfolio, the popular index in Borsa Istanbul, which is BIST 100. So this is the index of 100 stock. So BIST 100 index in Istanbul. So we're going to use this one as a market portfolio. So we need it. Just click this, and you go to the historical data. So from here you change your daily time frame, monthly. So again, so you will set the same dates. So again, the dates will be 3rd of the March 30, 2008. Apply, and you press this download button, and it will come. So open this. Wait, yes, we have here. So okay, just click it, double click it, you will see the first 2 columns again. So just double click it, because sometimes so the width of the column is not enough to show you these numbers, so that's why they show you this hash signs. So what you do, you just bring your cursor here and just double click, so it will open. Double click. Okay, so here you see again the same data. So wait, so this data is starting from 18th of March and till March 2018 till April 2008. So we need to sort it out, because as you see that our other data, So this one, the other data is here. So this is sorted in ascending order, ascending order. So here we need to do it again here. So what I do here, so I select these all columns. So this one, I select them all again. So from here, I sort it. So let's go to the custom sort, and here sort by weight. So let's select all of them together. So from first column, look. So here you bring your cursor here, select this one date, and press Control Shift right arrow. So it will select up to the last column of the data, and then press the down arrow. You keep pressing Control Shift and down arrow. So it will select all the data. So now we will go to the sort, custom sort. So here you see the column sort by the date, sort by date. So here they are saying to you oldest to newest. So we need this one, oldest to newest. So it will be ascending order. So I press this one. So look. So yes, we have a problem here, because so it is taking this 9 as the lowest number, and 9th of January, 10th of January, it is doing it like this. So the best way to do this is you go to here again to the investing.com and just click this date button. So it will correctly sort it out. So again you press the download button. So it will download again. You open it. Now this time, wait. Yes, the new data. So it is starting from 8th of April, 8th of May, 8th of June, July, like this. 2008, April 2008, May, June, July, and August, likewise. So now it's in ascending order. Okay. Again, we need to select the first two columns. I press Control Shift down, copy, and again I go to my sheet here, and I come here and I press Control V, or you just press this button, paste. So it is here. So now let's name it. So BIST 100, the market portfolio. So let's make it margin center. Let's make it bold, the same. So as you can see, all of the data, the Turkish Airlines, Turkcell, and the market portfolio BIST 100, they are starting from 2008 April, and all of them, they are in ascending order. Make sure all of your data, this two stocks and the market portfolio data, it's in this form. Okay. Now here we go. So we are done with the requirement number 1. So download any two stock price monthly data for the last 10 years from investing.com into the Excel sheet. We have done this. So the second point is download the same period data for the market portfolio like BIST 100. So okay, so look, if you are working on New York Stock Exchange, for example, or the London Stock Exchange, if your stock data is from London Stock Exchange, so you will use the market portfolio LSC, London Stock Exchange 100 Index. Okay, so make sure the market portfolio. So it should be from the same market in which these two stocks, they are listed. Listed means they are traded over there. Okay, anyway, so let's follow this pattern. So we have downloaded the market portfolio. Okay, so number 3 is calculate log returns or daily returns. Daily, or here we are using with monthly data, so we will write it monthly returns. Log returns are monthly returns of the stocks and market portfolio. So we need to calculate the log returns or monthly returns. So let's close all of the other files, so they are disturbing. So the other one, so let me close the other one, so do not save. So here, this one. Okay, so I have this file, I am working on it, my name, so I'm working on this file. So let's calculate the returns, log returns, monthly returns, you can say. So returns, log returns are here. So again, I will copy this one, I put it here, paste, Control V, just to save time. So what I do again, I make it bold. Okay. So now log returns, how you gonna calculate it? So you select this one. So you are on this column. So you need to have one observation before. So at least one. So here, what I do, I go here. So first you go here and then you click here. You press equal ln, you open the bracket. So what you do is, so this price, this one, you divide it by this one, the previous month price. The 2008 May closing price and 2008 April closing price. So this one, the latest price divided by the oldest price, the old price, the previous month price. So you just close this bracket and press enter. Okay. So this is the log returns. So it means that this stock has lost 7.9% as compared to the previous month. You see, so here the price was the price is 0.77 and now it is in the previous month it was 0.836, now it is 0.772. Let me see what is the price now. So we have the price 19, so huge increase. Oh great. Okay, anyway, so nothing to do here. So anyway, so now you need to do the same for here. So we need to calculate this log returns for all the months. For example, for here, so in the June 2008, the price is 0.585 TL, and we need to calculate the return here as well. So what you do is, so you bring your cursor here, so you just double click. So it will calculate the log returns for all the months. Okay, so you will have it at the end of, look, till March 2018 we have this log return. So monthly log return. Okay, let's come back. Again you will do the same for Tuxel. So again this one ln. So you open the bracket. So this one here you divide it by the previous price. Okay. So close it. This one again you select this and bring your cursor here. When it turns to black, double click. So do the same for the market portfolio, this one, BIST 100. So what you do? So what you can do is you can just copy this one, just press Control C or copy and just do it here, paste, Control V or paste. So it will automatically copy only the formula, not the number. That's the formula. You see the formula is here. Now if you click this one, so it has automatically copied the formula from here to here. That's the formula. Okay. Just press enter. Again select this and when our cursor moves to black plus, double click. So now we have log returns for all the months, right? So okay. So let's press save. Press save. Okay. So now let's move on to our this list of the things that we need to do. So now number 4. So we are done number 3. So calculate log returns or monthly returns of the stocks and market portfolio. Great. So calculate the arithmetic average returns of the individual stocks and the market portfolio. So now we need to calculate the average returns, right? So here, so what I do here, so let me write it here, the here I write Tuxel, and here I write the BIST market portfolio. This is our market portfolio. Okay, so here I write the returns. So average returns, okay, I calculate the average return. Average is simple average, the average monthly returns. So I come here again. So what I do, I press equal to, so I write average. And we're going to calculate the average. You see here, the average comes here. Just double click on it. It will come like this. So number 1, 2, 3. So what you can do is, so we are doing it for Turkish airline log returns. You come here. So again, you just press, you click here, and then what you do, Control Shift down arrow, down arrow. It will select the whole column. So you come here, you close your bracket, come back and press enter. That's it. So these are the average monthly returns for Turkish Airlines. So likewise, we can do it for Turkcell as well. So again, you click here, equal to average. I write it, bracket. Again, you do it for Turkcell. These are the log returns for, excuse me. So log returns for Turkcell. So click here, Control Shift down arrow. So again, so what I do, I close my bracket. Close my bracket, press enter, and that's it. These are the average monthly returns for Turkcell, right? So let me check. Yes, so average monthly returns, the price was 7.4 10 years ago, now it is 15 anyway. So BIST, likewise you will do it for BIST, equal to, so average, so I can write it here as well. So log returns are here, so I close the bracket. Now we have average returns. Let's make it bold. Average return for Turkish Airlines, Turkcell and BIST 100. Okay, great. So now let's follow this one. So we are done with 4 arithmetic average returns of the individual stocks and the market portfolio. Number 5, calculate the risk or standard deviations of the individual stocks. We need to calculate the risk of these stocks. So the risk is just the standard deviation. So as we have seen in our lectures, so the risk is standard deviation. So what we do is, we come here, again equal to, the Excel can do it for you, STD. So I do it standard deviation S, this one, standard deviation S. So again, so you will click this one, the log returns for Turkish Airlines, this one. Again press Control Shift down arrow and you close the bracket, press enter. That's it. This is the risk of the average. This is the risk of the monthly risk of the portfolio. Here for the Turkcell, you will do it same for the Turkcell, again equal to standard deviation. Okay, so great. So these are the risk level for the individual stocks. That's it. So we are done with our number 5. Calculate the risk or standard deviation of the individual stocks. Okay. So now calculate the correlation between the two stocks. Now we need to calculate the correlation. What is the correlation between the returns of these two stocks? So correlation, let's write it, correlation. Okay. So this one, so what I do here is, okay, so equal to correlation. So you see a formula here, we double click it. So A1 and A2, we need to have 2 variables here, variable series. The first one is the log returns of the Turkish Airlines. So I click here, again Control Shift down, I need to select whole column, then you press comma. So now array 2, the second variable is this one, the Turkcell log returns of Turkcell. So you select first one, Control Shift down, so F4 to F122. So I close the bracket, press enter. So this is the correlation between the monthly returns of Turkish Airlines and Turkcell. Quite a high correlation, 0.59. So anyway, it's less than +1, so we will have some diversification benefits. If we combine these 2 stocks into a portfolio, we may have some diversification benefits as the correlation is less than +1. right? So the lesser the correlation, so the higher the diversification benefits are. Okay, so let's follow this one. So calculate the risk of the individual stocks. We have calculated the risk, calculate the correlation of the between the two stocks. We have done it. So number 7, calculate systematic risk betas of each stocks using regression. Regress stock returns over the market returns. As you know, as you might remember, so how you calculate your uh, the beta of the stock is just how the stock is related with the market portfolio returns, how the stock returns are related with the market portfolio return. In this picture you are saying that on the horizontal axis, the market return, this is S&P 500 market portfolio monthly returns, and here you see home department, it's a stock, the monthly returns. So here in this graph we see how they are related, the home department stock monthly returns, they are related with the market portfolio of S&P returns. So in this graph the slope of this line tells us the beta of this stock, so how this stock is related with the market portfolio. So the beta is 0.67. So we will see how we can calculate this beta in Excel. Okay, so formally, so this is an informal way to calculate it. So formally what we can do is we need to have market returns and the stock returns. So what we do, we come here and what we do, so we go to this data and we will go to this data analysis. So in your Excel you may not see this data analysis tab here, this button. So what you do, so you go to file, you need to activate it. Actually it's there, but you need to activate it. So you go to your file, click here, go to options, and you see add-ins, and you will see some active application add-ins, there are some inactive application add-ins. So you have all these, for example, all these analysis toolpacks, toolpack, analysis toolpack, VBA, your tools, all of them, you will see them here inactive. Just click them and press go. So you press go and okay, you will see them there. So simple is that I have already activated them, so they are in my this list, active application add-ins. So anyway, so you can activate it like this. So I press data analysis. In the data menu or data tab, so here you will see this. So here you will select regression. We need to regress the stock returns over market returns, just like this picture. Okay, so you will go regression. Okay, please wait, I think it will, oh yes, it is here. So input y, so here y is our dependent variable. So dependent variable in this case is our stock returns. So stock returns, I need to tell it the stock returns. So I press this button, this one, and I need to select this one, the Turkish Airlines stock returns. So what I do, I click here the first and then again control shift down, so it will select all of that. I will click here again. So here I need to select the input x range. X is our here the independent variable is the market returns. So here I click this one and I go up, market returns are here, the log returns based 100. So I click here, control shift down, press this one, that's it. So here you just press OK. It will give you the results into a new sheet. Okay, so you will see this. So here I am not going into the details of this regression analysis. Here we need this one. So 1.075, this number. This is the beta coefficient of Turkish Airline. So 1.075. So this is, so I am coming back here to my sheet 1. So this is a new sheet. It is being opened here. So sheet 1 is here. Yes, sheet 1 is here. So what I do here, so in sheet 2 I have 1.075 in sheet 1. So I go up, so let's write the beta. So the beta of Turkish airline is 1.075. As I have explained, if the beta of a stock is greater than 1, is higher than 1, it's an aggressive stock. It's almost close to 1, but still it's higher than 1.075. So if the market goes up by 1%, this stock will go up by 1.07%. So there is a positive relationship between the Turkish Airlines stock and the market returns. So it is an, we say that Turkish Airline is a bit aggressive stock. Okay, let's calculate the beta for Turkcell. Likewise the same. So you go to data analysis, regression. Okay, so again in the Y range, what you do, you will change it to the log returns of the Turkcell. So I select log returns here. So here, so again I press here. So you do not change this input X range because we will use the same market returns. The returns of the market portfolio is here. So I just press OK. So it will again give me in a new sheet, in the same workbook. Look, the workbook is same but in the new sheet. So here you see here X variable 0.66. So this is the beta of Turkcell. So 0.665. So I go to my sheet 1. So I write it 0.665. Okay. Now we have the betas of individual stocks as well. Okay, so we are done. So beta, sorry. So this is the measure of a systematic risk. As I have explained, the total risk of any stock has two portions: unsystematic risk and systematic risk. Beta tells you the systematic risk of the stock, how the stock reacts to the market changings. The Turkcell stock, its beta is less than 1. If the beta is less than 1, this means that this stock is a defensive stock. It means that if market goes up by 1%, this stock will go up by 0.665%. So if the market goes down by 1%, the Turkcell stock will go down by 0.665%. So less than 1%, and it has a positive relationship with the market. So it moves with the market, but it's a defensive stock. Okay. So we are done with our requirement number 7. So we have calculated the systematic risk or beta of each stock. So now calculate the expected returns of the stocks using CAPM. Yes. Now let's see how we can calculate the expected returns on these stocks using CAPM. So CAPM, as you know, that tells the CAPM, the expected return is equal to your risk-free rate of return plus beta into the market risk premium. So here we assume that our risk-free rate of return is risk-free. The rate of return that you earn on T-bills, the risk-free, so that you can earn without taking any risk. So the risk-free rate of return, in this case, we assume that, for example, it is in Turkish markets, it's around 14% per annum. So this is our monthly data. So your risk-free rate of return should also be a monthly rate. So here we are, so the monthly risk-free rate is, for example, it is, let's do it at 1.02. This is risk-free rate of return. Okay. So what is the expected return using kappa? So risk-free rate of return is here. So the expected return using these stocks. So look, these are the average returns. So using normal arithmetic average. Using the CAPM, the more formal way to calculate the expected return on this Turkish airline. So how you do it? So I come here again, I click here and as you know, this is risk-free rate of return, this one, risk-free rate of return plus risk-free rate of return plus beta of this stock. The beta of this stock is this one, 1.075, and you multiply it. Premium. Risk premium is equal to risk premium is equal to your market returns minus your risk-free rate of returns. So risk-free rate of return is here, the risk-free rate of return, this one. So I close my bracket and I press enter. So this is the expected return using CAPM on Turkish Airlines using this monthly data. So likewise you will do the same for the Turkcell. Is equal to, so risk-free rate of return is here, plus the beta of the stock multiplied by into Rm, the market returns minus Rf. Rf is here, this one. So okay, so let's close this bracket. So let's check it. So L7 risk-free rate of return, M6 is beta on Turkcell. So N3 is the market returns, and they are, so L7 is the risk-free rate of return, right? So one thing please, as they are not in percentages, they are like normal numbers, 0.026. So actually it's 2%, or here it is 0.8%. Anyway, so this one should be, I wrote it in percentage by mistake. So what you do is, let's make it so in normal numbers, so 0.0001. Automatically your expected return on capital will also change. So on risk-free rate of return is this one, 0.0012, or in percentage. So let's make it 1.2%. Okay, so 1.2% is our risk-free rate of return. So 0.02. Okay, so this is how you calculate your CAPM. So you can calculate this risk-free, you can use this risk-free rate of return in your assignments. Okay, so let's continue. So calculated the expected returns of the stocks using CAPM. Okay, so we have done with this one. So the CAPM expected returns are here. Okay, so okay, so now calculate the portfolio returns. So portfolio return will be equal to, as you let's to calculate the portfolio return. So portfolio portfolio return is equal to, you can use this one, the expected returns on capital, the weighted average return on individual stocks. So you can use this as a portfolio return. So equal to, so please wait. So here one thing, so we need to decide how much of our wealth we're gonna invest in Turkish Airlines and Turkcell. We assume that the weights is equal. 50% we invest in Turkish Airlines and 50% we invest in Turkcell. Okay, the portfolio return is equal to the weighted average returns. So weighted average is W1. So W1 is here. W1 multiplied by the R1. R1 is the return on Turkish Airlines, return on first stock, plus W2, this one, into the expected return on the on the Turkcell. So this one is this one. Okay, so you just press enter. So this is your portfolio return on your the portfolio that you make if you combine these two stocks. So this is the expected return on these portfolio. Anyway, so expected return is here, the portfolio return using these returns, the CAPM expected. So if you invest here in Turkish airline, your expected return is 0.0079. If you invest all of your money on Turkcell, you are expecting 0.0094. And if you combine that up, so you are expecting this much, 0.0087. So in percentage, 0.87 2%, and here 0.79, and here 0.94%. Anyway, so let's do this to calculate the portfolio return. Okay, so now we need to calculate the portfolio beta, the systematic risk of our of this portfolio. So now let's calculate the portfolio. Again, just like the portfolio returns, so portfolio beta is just the weighted average of the betas of the stocks. Okay, so equal to, again, so weight multiplied by the beta of stock 1, the Turkish airline, plus weight 2 multiplied by the beta of the stock 2. Okay, so your portfolio beta is 0.87%, just the weighted average of these betas. Anyway, so this is the requirement number 9, the portfolio. So requirement number 10, the last requirement is they calculate the portfolio risk. Now you need to calculate the portfolio risk. So let's calculate the portfolio risk. Portfolio risk is equal to, as you remember from our lectures, so portfolio risk will be, so W1 square, the square of this one. So how we can take the square? Okay, so I need to check. This sign, you find this sign on your keyboard. So this is W1 square multiplied by W1 square multiplied by the risk of this or the stock 1, this one, the square of this one. So let's put it like this. Again, the square, we need to calculate the square. Close this. So now W1 square into the sigma 1 square. The sigma is the standard deviation of Turkish airline stock. So plus W2. W2 is again this one. So let's open the bracket. W2 is here. Square. W2 square and the sigma 2 square. Sigma 2 is the risk of stock 2, the Turkcell. So let's open the bracket again. And plus 2 into W1, 2 multiplied by W1 multiplied by W2 multiplied by sigma 1. Sigma 1 is here, this one, multiplied by sigma 2, Turkcell is here, and multiply by the correlation coefficient. The correlation coefficient is here, this one. So you just click it, L5. This is L5, 0.5971. So that's it. So this is the risk of the portfolio. So if I just press this one, so that's it. So as you can see, the correlation coefficient between those two is very high, so almost 0.60, very high. So yes, still you are reducing the risk of the portfolio here. 0.073. If you invest here, it is 0.11, here 0.074, but here the risk is 0.0073. So you can expect a return of 0.0087. This is the return that you are expecting here. Look, so if you invest in Turkish Airlines stock, so this is the return you are expecting, 0.0079. Here 0.0094. But if you combine them up, so the expected return is 0.0087. Good, but the risk is very low as compared to these individual stocks. You see here, this is 0.1165 and here is 0.07, but here the risk of the portfolio is 0.0073 with this return. So you get some benefits of the diversification to making a portfolio. So if you can find stocks that have very less correlation or close to negative, zero or close to zero or even negative, so you will have even more diversification benefits. So thank you very much for listening me. So